If Warren Buffett walked into a room and told you the rules that actually make people rich, most people would hate them. Not because they're wrong, but because they expose a quiet truth no one wants to admit. The financial advice you hear every day? It was never designed to make you wealthy. It was designed to make you comfortable. And comfortable people don't change class. Let me ask you something. If the public rules worked, why are 99% of people still trapped trading time for money? Why do they work for 40 years? Invest consistently. Follow every safe strategy. And still never cross into real freedom? Here's the uncomfortable answer. There are two sets of rules in this world. One set is printed in textbooks. The other is whispered behind closed doors. One set keeps you stable. The other builds empires. And today, we're pulling back the curtain. Because Warren Buffett doesn't think like the public. He operates on something far more dangerous. A different operating system. And if you don't understand it, you'll spend your life playing a game you were never meant to win. Now here's where it gets interesting. The 99% are obsessed with being smart. The 1% are obsessed with not being stupid. Read that again. Because that single difference explains more about wealth than any stock tip ever will. Most people ask, how do I get rich? Billionaires ask, how do I make sure I don't go broke? That flip changes everything. And it leads to rule number 1. The rule that sounds simple, but almost no one follows. It's called inversion. Instead of chasing brilliance, you eliminate stupidity. Instead of hunting for the next big win, you avoid catastrophic loss. And here's why that matters more than you think. If you lose 50% of your money, you don't need 50% to recover. You need 100%. Lose 80%? You need 400% just to break even. That math is brutal. But nobody talks about it. Because chasing gains feels exciting. Avoiding loss feels boring. And in our educational motivational culture, excitement sells. Patience doesn't. Let's go back to the late 1990s. The dot-com bubble. Everyone was getting rich overnight. Teenagers trading internet stocks. Taxi drivers giving stock tips. Companies with no profits skyrocketing. And Buffett? He did nothing. He was mocked, called outdated, too slow, a dinosaur. He didn't understand the new economy, they said. But here's what he understood better than anyone. He didn't know which company would win, but he knew what would destroy them. No earnings, no cash flow, sky-high valuations, business models no one could explain. So instead of trying to be a genius, he refused to be stupid. When the bubble burst, fortunes vanished, careers ended, retirements erased. And Buffett? He survived. That's the part people underestimate. In the game of compounding, survival is everything. You don't have to be the smartest. You just have to stay in the game long enough. That's not flashy. It's not viral. But it's powerful. Now here's the emotional shift. Most people secretly want to look smart. They want to predict trends. Call the next big thing. Impress their friends. But wealth isn't built on ego. It's built on discipline. Buffett once said the only way a smart person goes broke is through leverage. Debt. Overconfidence. Big bets they don't understand. And this is where most people self-destruct. They don't blow up because they're stupid. They blow up because they were almost right. Close enough to feel confident. wrong enough to get crushed. The shadow rule says, remove the fatal mistakes. Don't trade what you don't understand. Don't borrow what you can't repay. Don't chase what you can't explain. It's subtraction, not addition. And that's uncomfortable. Because we're taught success is about adding more. More income streams. More side hustles. More risk. More action. But the billionaire mindset? It's about fewer, better decisions. Imagine your financial life as a minefield. Most people run across it hoping they won't step on something. Billionaires map it first. They move slowly, deliberately, sometimes painfully. And that slowness looks like weakness until it doesn't. Here's the micro truth no one wants to hear. You don't need to be extraordinary. You just need to avoid extraordinary mistakes. But that requires something rare. Emotional control. Because while everyone else is celebrating quick gains, you'll be sitting still. While others brag about 10x returns, you'll be holding cash. While friends tell you you're missing out, you'll be quietly saying no. And that's where most people fail. Not in strategy. In psychology. Because following these rules means you'll look wrong. For long periods of time. You'll feel behind. You'll question yourself. You'll wonder if maybe the crowd knows something you don't. But here's the twist. The crowd always looks smart at the top. And foolish at the bottom. The billionaire plays a different timeline. He's not trying to win this month. He's trying to win the decade. And that shift, from short-term validation to long-term dominance, is the doorway between middle class and mastery. So here's the challenge for you. Stop asking, how do I get rich? Start asking, what could ruin me? List the financial behaviors that could destroy your future. Over-leveraging, speculation, lifestyle inflation, emotional investing, and eliminate them. Because rule number 1 isn't sexy, but it's foundational. And without it, the other 6 rules don't matter. Now here's where it gets even more controversial. Because if avoiding stupidity keeps you alive, there's a second rule that actually creates massive wealth. And it directly contradicts what your financial advisor tells you. It challenges diversification. It challenges safety. It challenges comfort. And almost no one has the courage to execute it. What if diversification is actually keeping you poor? That sounds reckless, dangerous, almost irresponsible. And that's exactly why most people never question it. From the moment you open a brokerage account, you're told the same thing. Spread your risk. Don't put all your eggs in one basket. Own a little of everything. It sounds wise. It sounds mature. But here's the uncomfortable question. If spreading everything out creates billionaires, why did almost none of them get rich that way? Let's look at reality. Bill Gates built his fortune through one company. Jeff Bezos through one dominant bet. Elon Musk through concentrated conviction in a few massive plays. None of them built wealth by owning 100 average positions. They built it through focus. And that brings us to rule number 2. Radical concentration. Now pause. This is not gambling. This is not recklessness. This is clarity. Buffett once described something called a punch card mindset. Imagine you're handed a card at age 20. You get only 20 investment decisions for your entire life. Every time you invest, one hole gets punched. When you run out, you're done. No more moves. How differently would you act? You wouldn't trade weekly. You wouldn't chase hype. You wouldn't invest because Twitter told you to. You would wait. And wait. And wait. Because every decision would matter. That changes everything. Here's the psychological twist. The public believes wealth comes from activity. Buying, selling, adjusting, rebalancing. The billionaire knows wealth comes from precision. One exceptional opportunity. Executed heavily. But here's the tension. Waiting is uncomfortable. In our educational motivational world, we're taught to take action. Move fast. Don't miss out. Hustle. Stillness feels like failure. But in investing, stillness is often strength. Picture a crocodile sitting by a river. Days pass. Nothing happens. Weeks pass. Nothing. It looks lazy, useless. But when the right prey steps into range, it explodes with precision. That's concentration. Most people are casting fishing lines everywhere. Billionaires are waiting for one perfect strike. And here's why this rule is so difficult. Because it requires conviction. If you concentrate, you must truly understand what you own. You must know the business model, the cash flow, the moat, the risks. You can't hide behind diversification. Diversification protects ignorance. Concentration rewards knowledge. But that's terrifying for most people. Because what if you're wrong? Exactly. That fear keeps people average. Now here's where this gets even more powerful. Buffett separates wealth creation from wealth preservation. Concentration builds wealth. Diversification protects it. The middle class diversifies too early. They protect something that hasn't grown yet. It's like watering 50 tiny plants instead of growing one massive tree. None of them get tall enough to cast shade. But here's the micro cliffhanger. Concentration doesn't just apply to investing. It applies to your entire life. Most people try to build 5 income streams, 10 side hustles, 20 goals, and they wonder why none break through. Energy divided becomes diluted. Energy focused becomes explosive. Let me tell you a story. Imagine 2 people. Person A invests in 50 decent opportunities over 20 years. Person B waits patiently, studies relentlessly, and finds 3 extraordinary ones. Who wins? History answers that question. The top fortunes in the world are concentrated bets. But here's the emotional cost no one talks about. Concentration means long periods of boredom. Long periods of doubt. Long periods where you look inactive. Friends might outperform you short term. Colleagues might brag. Social media might scream about the next big thing. And you're doing nothing. Reading, studying, preparing. It feels slow. Until it doesn't. Because when the moment comes, when valuation drops, when panic hits, when others are forced to sell, you act decisively and heavily. But this rule has a hidden requirement. It demands psychological independence. If you need validation, you won't survive concentration. Which brings us to rule number 3. Because even if you understand inversion, even if you embrace focus, you'll fail without mastering one internal skill. The inner scorecard. And this is where wealth becomes a mental battle. Because what destroys most investors isn't ignorance. It's social pressure. It's reputation. It's the fear of looking wrong. And in the next part, we're going to step into something deeper than money. We're going to talk about ego, about identity, about why most people would rather look rich than actually become rich. And once you see it, you'll never view status the same way again. Would you rather be truly successful or just look successful? Don't answer too quickly, because this question has destroyed more fortunes than bad investments ever did. Here's the uncomfortable truth. Most people live by an outer scorecard. They measure their worth by applause, by followers, by neighbors' opinions, by what looks impressive from the outside. But billionaires? They operate from something far more dangerous: an inner scorecard. And this is rule number 3. Because without it, the other rules collapse. Let me explain. Imagine you make an investment decision that you know is correct. The numbers make sense. The risk is low. The long-term outlook is strong. But everyone around you says you're wrong. The headlines mock you. Your friends question you. The market moves against you temporarily. Do you hold or do you fold? This is where most people break. Not because they lack intelligence, because they crave validation. Now think about this. Warren Buffett has lived in the same house in Omaha for over 60 years. He drives modest cars, eats simple food, avoids flashy displays. Why? Because he doesn't need an audience. And that psychological independence is priceless. In our educational motivational culture, we're told to build a brand, to show success, signal success, broadcast success. But here's the twist. The desire to look wealthy is the fastest way to stay middle class. Luxury car leases, oversized mortgages, designer everything. It's financial theater. And theater is expensive. Here's the micro tension. When your self-worth depends on external approval, your financial decisions become emotional. You buy to impress. You invest to prove something. You take risks to avoid looking foolish. And that's deadly. Because wealth requires looking wrong sometimes. Think back to the dot-com bubble. Investors who refused to buy tech stocks were laughed at. They seemed outdated, behind the times, out of touch. But when the crash came, the laughter stopped. And that's the power of the inner scorecard. Facts don't change because of popularity. Truth doesn't need applause. But here's where it gets deeper. The real test isn't investing. It's identity. Let me ask you something brutally honest. Would you rather be the best in the world at something, but have everyone think you're mediocre? Or be mediocre, but have everyone think you're elite? Most people choose the second option without realizing it. Because reputation feels immediate. Reality compounds slowly. And compounding is invisible at first, which makes it easy to abandon. This is why rule number 3 is psychological isolation. You must be willing to stand alone, to make decisions that look boring, outdated, unimpressive. You must detach from applause. And that's rare, because our brains are wired for belonging. Social acceptance once meant survival. But in modern finance, it often means conformity. And conformity rarely builds extraordinary wealth. Now here's the emotional shift. The inner scorecard doesn't just protect your money. It protects your peace. When you stop performing for others, you free cognitive energy. You stop comparing. You stop chasing. You stop reacting. And suddenly, patience becomes easier. Concentration becomes possible. Inversion becomes natural. Because you're no longer playing to the crowd. You're playing to the math. But this rule has a dark side. It's lonely. There will be seasons where you question yourself, where you feel behind, where others seem ahead, and you'll have no applause to reassure you. Just conviction. That's the price. But here's the payoff. When you operate from an inner scorecard, you can hold through volatility. You can ignore hype. You can avoid lifestyle inflation. You don't upgrade your car because your neighbor did. You upgrade your assets. You don't expand your expenses. You expand your ownership. And that difference? It compounds silently. Now let's go deeper. Because even if you master your ego, even if you focus intensely, even if you avoid stupidity, there's one more rule that feels completely counterintuitive. It sounds lazy. It looks passive. It contradicts hustle culture. And yet, it may be the most powerful rule of them all. Rule number 4. The art of doing nothing. And this is where the average person loses their mind. Because in a world obsessed with motion, stillness feels like weakness. But what if the real edge is the discipline to wait? In the next part, we're stepping into the quietest advantage in the billionaire playbook. And once you understand it, you'll realize why constant action might be sabotaging your future. What if the most profitable move you could make this year is doing absolutely nothing? Feels wrong, doesn't it? In a world screaming, hustle harder, move faster, scale now, stillness feels like falling behind. But here's the secret almost nobody in the 99% understands. Activity is not the same as progress. And that's rule number 4. The art of doing nothing. Now let's be clear. This is not laziness. It's controlled restraint. It's the discipline to wait when everyone else is reacting. Walk into most trading floors and you'll see flashing screens, constant chatter, frantic movement, energy everywhere. But real compounding? It's quiet. Warren Buffett once described his ideal day as reading and thinking. No constant trading. No dramatic moves. No adrenaline addiction. Just filtering. And this is where the educational motivational mindset must shift. We've been trained to believe that busyness equals productivity. If you're swamped, you're important. If you're exhausted, you're ambitious. If you're constantly moving, you're winning. But in investing, and in life, constant motion creates friction. Taxes, fees, emotional decisions, burnout. Money is not made in the buying and selling. Money is made in the waiting. Here's the micro tension. When you plant a tree, you don't dig it up every week to check the roots. But that's exactly how most people treat investments. They check prices hourly, react daily, panic monthly, and every reaction interrupts compounding. Compounding requires time, silence, space. Now here's the uncomfortable psychological truth. Doing nothing is incredibly hard because your emotions will attack you. You'll feel boredom. You'll feel anxiety. You'll feel like you're missing out, especially when markets surge, especially when friends brag, especially when social media celebrates overnight gains. And that's when discipline matters most. Picture a crocodile sitting by a riverbank, motionless. Days pass. Nothing happens. It looks dead, but it's not inactive. It's prepared. When the right opportunity enters range, it explodes with precision. That's what disciplined inaction looks like.